So today we're going to talk about why I believe we are in a recession, and stay to the end because I'm going to talk about tactics that I'm doing and you could do to mitigate your risk. There are many definitions of what a recession might be. I'm going to talk today about a balance sheet recession, which is rarely discussed. A balance sheet recession focuses primarily on debt, and we, folks, are in a debt crisis. A balance sheet recession is a type of economic recession that occurs when high levels of debt cause individuals or companies to collectively focus on saving by paying down debt rather than spending or investing, causing economic growth to slow or decline. So why am I talking about this now? Because when debt was cheap and it was 0 or 1% or 2% and people were getting mortgages at 2-3%, it wasn't a problem. But now that debt has more than doubled, people are starting to see the problems. They're starting to not be able to pay their credit card balances, which are over 20%. And they're not buying homes, of course, because rates are at 6 and 7%. And of course, commercial interest rate is defaulting as we speak. So in this slide, I'm going to talk about both public debt and private debt because I think both are important right now. So as you guys know, we just had a big debate over the debt ceiling, which just got approved. But the total U.S. gross debt is now at $31.4 trillion at the end of 2022. $24.5 trillion of that, or 78%, is actually deemed as public debt, meaning that it's cash borrowed from domestic or foreign investors. One big issue that just happened in the last 30 days is that the U.S. national debt surged by $1 trillion in just 1 month since the borrowing ceiling was just lifted by Congress. This is a potential problem and something to watch as we move forward. The second big one, of course, which I've talked about, is that we have $1.5 trillion of debt looming for U.S. commercial real estate. Now, this is office, retail, multifamily, even self-storage has and could fall as much as 40%, which means that the values of these properties are not even worth the loan. The next one is student loan debt, which is $1.75 trillion right now, or almost $30,000 per student per borrower on the average. We've all heard the stories around student loans, which apparently are going to have to start being paid in the fall of this year. And the last one is consumer debt, and this is one big catch-all. So this is mortgages and auto and all those kinds of things, including credit card debt, is at a record almost $17 trillion, and delinquencies are up as Americans now owe over $1 trillion in credit card debt. Don't forget, with all debt, there's what we call counterparty risk. There's somebody on the other side of that debt. Somebody is owed that money. So as debt defaults, it doesn't just go poof and go away. Somebody actually takes that hit. So if you're owed Social Security or a pension or Medicare, that could take the hit if you're a retiree. If you're in the commercial real estate debt, then that could make its way into your retirement accounts as we start to see these insurance companies and big pensions write down the commercial real estate market. The next one, of course, is student loan debt, and that's a wild card. Who knows whether or not that will be repaid at any time soon and what the defaults are going to be. The consumer debt is the one that you need to continue to watch, as Americans are continuing to rack up more and more credit card debt and their personal savings continues to go down. So why am I concerned about this? Because the cost of debt has more than doubled. And now, of course, the point of a balance sheet recession is that people are going to start diverting more of their income to paying debt as opposed to consuming and investing, which is what the entire economy is built on. So now let's take a look at good debt or bad debt. Good debt is debt that's used to provide passive income or that has some kind of a return. Bad debt would be the opposite. Let's say buying something that depreciates right after you buy it, like a boat or a car, for example. Some of the types of debt are mortgages, businesses, auto, credit cards, student payday loans, consumer debt, and of course, entitlement programs, which are Social Security, Medicaid, healthcare, etc. There's arguments about whether this is good debt or bad debt, but the bottom line is, does the actual investment or is there enough income to cover the debt? If it's not, it effectively goes over to the bad debt column. So there's 3 stages in the pattern of all borrowing. Stage 1, borrowers expect to be able to pay both the interest and to repay the principal from the cash they expect their investment and or income to generate. I think everyone's optimistic at this stage. Stage 2, borrowers' hopes are limited to paying the interest, and due to the lack of income or value that was declined, the refinancing and the principal is now not an option. This is generally where we are right now. Stage 3, the interest payment is not made due to the lack of income, and the loan goes into default or the loan is due. But the loan is not necessarily worth the value as it sits today. So if you take a look at the debt crisis that we're in today, the government is in a bad position because it owes a lot of money and entitlement programs. And of course, those are going to be paid, but they're going to have to print that money, which is going to create more and more inflation down the road. So the second one, of course, is commercial real estate debt, which we've talked about. And those loans are starting to default because the values of those properties are not worth the current loans. And those are going to start to show up in the smaller regional banks and, of course, inside of your statements, whether it's insurance or pension, 401k, or retirement program. And, of course, commercial debt and student loan debt are a little bit of a wild card. This is primarily based on wage growth and the borrower's ability to pay back those loans over a period of time. So in traditional balance sheet recessions, people divert their income to pay down debt as opposed to consuming or investing. And when consuming and investing goes down, that means that GDP will also go down because GDP is based on consumption. So we're already starting to see reduced borrowing, reduced spending, reduced savings. People are struggling to pay off their debts. And of course, there's a rush to sell off assets to pay off the underlying debt that many people owe. So it's not all bad news because a lot of people can make a lot of money during recession. So these are balance sheet recession tactics that I suggest you take a look at. I did review these in a prior video, but I think it's important that you understand that these are the things I'm doing and these are the things that you need to do in order to survive this recession that's about ready to hit us. So number 1, review your asset exposure like the banks are doing right now and sell off your marginal assets. Anything that's negative or no cash flow, you need to get out of right now and make sure that you're fixing your debt, because what you can do is you can always hedge the up and you can always refinance the down. That's the important thing. We don't know what the Fed's going to do. They've said that they were going to raise the rates 2 more times, but who knows? Definitely build up your cash reserves because cash is king. Use inflation as your 2023-24 strategy because I don't see this going away because the government's going to have to print more money and they're going to have to inject more stimulus either directly to the people or to the banks to be able to prop up the economy to continue to keep it moving forward. Expect more loan defaults. We've already talked about this. We're at the very beginning. We're in the first few innings of this, and which is going to create some bank instability and failures. And just be patient. Wait 1 or 2 years. Build up your cash reserve. Do not catch a falling knife. Let the knife fall. Let it hit the floor. Let the bank own the knife and then go negotiate for the knife. That's the time that you want to buy assets and get ready, and just get ready to have your cash together and solve the bank's problem.